Hey there, welcome to Be the Boss of Your Money. I'm Mitch Goldberg. We're just getting started. Thank you for joining me. We've got a couple of things to talk about. We're talking about the market. We're talking about personal finance, business strategy. These are the things we talk about on Be the Boss of Your Money because I want you to be the boss of your money, not your money to be the boss of you. But today I want to talk about something that is like the elephant in the room, the most blatantly obvious thing that we all know about, but maybe we need to know a little bit more about, and that is the S&P 500 index. There's a lot more to know about it than just say the S&P went up today or down today, or it was up last month, or that, up last quarter, down last quarter, what have you. Okay. So that's what we're going to talk about. I want to fill you in on a few things that you should know about. And there's a reason for this because it has a lot to do with diversification. So let's roll the intro and we're going to get into this. Stick around. This is going to be enlightening. Good evening. I'm Mitch Goldberg. I hope you are well. Thank you so much for joining me. This is Be the Boss of Your Money. If you're just joining me now in the live stream, welcome. If you have any questions, please ask away in the comments. That is my favorite part of doing this. I love it when you ask me questions, and words of encouragement are always appreciated as well. We're talking about the S&P 500, which is basically synonymous with the stock market. It's the most widely followed stock index in the world. There are more assets tied to the S&P 500 than any other index, and it's something that we should take a deeper dive into so that you actually know what it is. We always preach, know what you own. So let's make sure that we know what we own with the S&P 500. So on that note, if you're watching this in the replay, by the way, welcome to you as well. I would love to answer your questions. So ask away in the comments as if you were watching in the live stream. So before we get into the S&P 500, let's just take a quick look at how the stock market did today. It was an okay day. Actually, it was a kind of day that gives you a chance to catch up on things, catch your breath. Let's do a quick share screen. And I'll just fill you in, add a little wisdom. By the way, if you don't know this, I'm a financial advisor with over 30 years of experience. So I've picked up a few things and I love sharing it with you. It's something that I just love to do, and hopefully you get some value out of this. But the real way to get value out of watching my live stream is to actually ask questions in the comment section. So go ahead, ask away. Don't be shy. We're talking about the S&P 500, which incidentally was up today, 0.77%. It's been going down the last couple of days. Yes, I know you keep hearing about, the market's up, the Dow's up. The Dow and the S&P are different. Just because the Dow goes up doesn't mean the S&P has to go up also. And for example, today the Dow backed off just a tiny bit. The Dow is up, but 4% this week. It was up, I think, 7 or 8% last week. So the fact that it's off only 23 points, 0.08% is really, it's basically a non-event. The reason it didn't go down even more, though, were because of some of the tech stocks that are in the Dow Jones, and the S&P 500 had a pretty decent day because of a rebound in the work from home, super large cap tech stocks like the FANG plus M stocks we talk about. FANG plus M. Facebook, Amazon, Apple, Netflix, Google, Microsoft. FANG plus M. There's two ways when I say FANG. Okay, Nasdaq was up 2%, so up even more than the S&P 500, and that is really because it's got such a big component of tech stocks. Okay, I'm just getting that. I'm getting that ruthless drip right into the fall weather. You know what I'm talking about. It just never goes away. Russell 2000 was basically flat, but that's been having quite a surge lately. And finally, we see the VIX coming down below 25. That's the fear gauge. You want to see that go down. That when that goes down, that's a level of comfort uh, uh, on the part of big money managers, big fund managers, hedge funds, etc. That means they are not paying up for protection to protect their portfolios. Let's take a quick look at the sector ETFs. We're going to get into this a little bit more, but technology sector leading the way. These are the big ETFs that represent the 11 major sectors of the S&P 500. So there's fact number one. The S&P 500 consists of 11 sectors. GICS, General Industry Classification Standards, according to Dow Jones McGraw-Hill, right? XLK, XLC, communications, what's in the bottom, stuff that won yesterday, materials, energy, industrials, financials. But, these stocks have been up a lot the last 2 weeks, so I'm not really reading too much into that. All right, so let's take a quick break from this and let's talk about a few fun facts about the S&P 500. Pretty much all of us, one way or another, are exposed to the S&P 500 if you're an investor, because even if you're not investing directly into an index fund like that tracks the S&P 500, there's a good chance that the funds you are investing in still are benchmarking against the S&P 500 index. So they don't have to be exactly index funds. They could just be large cap funds that are tracking, that are supposed to track or not exactly track, but benchmark against, for performance purposes against the S&P 500. So just so you know, you actually can't invest into an index. You could invest into a fund or a security that tracks or mimics an index. Just want to get that out of the way. And diversification, when I talk about diversification, you've heard all the old expressions, don't put all your eggs into one basket. There's a lot of ways to define diversification, but it is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. But what it can do is prevent your portfolio from mimicking the return of the worst investment in your portfolio if you have a concentrated portfolio with just a few investments or just one investment, for example. Okay, so when I talk to you about the S&P 500, I've got some fun facts here. This is the first. Okay, hold on. Well, this is okay. So just a few. Let me start that again. So just a few fun facts about the S&P 500. It is the first market cap weighted index. Do you know what that means? It means a bigger company will have a bigger impact on the S&P 500 index than a smaller company. So the big companies have more sway over the S&P 500 index performance than small companies. People have been asking, why did the S&P 500 do so well when the economy was so bad during the pandemic? Because the biggest companies in the S&P 500, like the FANG plus M stocks, Facebook, Amazon, Apple, Netflix, Google, Microsoft, those companies actually are very well suited for the current times, for the work from home, stay at home, telecommuting sectors. So they've done very well now. Plus, they're the biggest stocks in the index, the biggest companies in the S&P 500 index. So not only are they doing well, but they're also the bigger companies, the biggest. So they have an outsized sway over the performance of the index. And I'll show you more about that, how the smallest companies in the index, when I show you how small their representation is in the index, you're going to be like, why even bother with those companies? So we'll take a look at that, maybe an alternative like the S&P 100 index instead. But I digress. There were 11 sectors, the General Industry Classification Standards. So let's take a look at that. And maybe you know this, but if I said to most people, can you name all 11 sectors? People could be like, I didn't know there were only 11 sectors of the S&P 500. I thought there were more. Well, I'm talking the general classifications. For example, well, that's really small. I'm going to make that a lot bigger so you can see it on your little smartphone screen. All right. Is that a little better? Ooh, that's a lot better. Okay. IT, that's technology, is almost 30, it's almost 28% of the portfolio of the S&P 500 index. Healthcare, 15%. Consumer discretion, 11%. Communication services, 10%. By the way, communication services has a big slug of Facebook and or is it Google, Facebook and Netflix. So I'm sorry, Google and Netflix. So that's almost half of the communication services. So if you take the communication services and IT, they're so similar that that's about 37, 38. It's almost 40% of the S&P 500. So that's why the tech sector is such a big deal and people follow it so closely, because I don't think a lot, I think a lot of people, I think a lot of people who are S&P 500 index investors don't realize how concentrated they are in technology and communications. And that's an issue, because if those sectors take a dip, a big tumble, fall out of investor favor, what you have is a potential for a lot of downside risk. So you should know that. I remember in the year 2000 how technology came down so hard. It was a disaster for the major averages. It was a disaster for any funds that tracked or benchmarked to the S&P 500, which pretty much is almost all large cap funds. You don't have to be an index fund, an S&P 500 index fund, to benchmark against the S&P 500. You could just be a large cap fund and benchmark against the S&P 500 as well for performance reporting purposes. And then we have consumer discretionary. That's consumer goods and services that you want, not necessarily need. Like you need food, but in consumer discretionary, it could be like, Harley Davidson motorcycle, or Tiffany, a jewelry retailer, etc. Okay. We've got financials, industrials, consumer staples, and they get smaller and smaller in their representation until you get down to utilities, real estate, materials, energy. And this is as of the middle of 2020. It hasn't really changed all that much in the last few months. If anything, technology's gotten maybe a little bit bigger. So just want to talk to you about that. And the reason I'm focused on this today is because I had a conversation with somebody over at CNBC. I know, like, I'm not trying to do a humble brag here. I'm just telling you, I had a conversation with somebody at CNBC, and we were talking about sector rotation, and what could investors do to get involved in this, or to make sure they're not caught one way or another with too much tech or too much or not enough of the other kind of stocks. So the issue is technology's been rallying. We've had the biggest sector rotation we've ever seen, where money was coming out of economically sensitive stocks and going into these large cap tech stocks. And then we saw, $1 trillion valuations. Apple hit a $2 trillion valuation. Microsoft over $1 trillion. Google over $1 trillion. So, Microsoft over $1 trillion. So we've had just these massive valuations, and that money had to come from somewhere. And it came out of the economically sensitive stocks like energy, industrials, financials, et cetera. This, we keep talking about these stocks, these sectors. So now we're starting to see just a tiny bit of a reversal. It's not a big reversal. It's just, a little bit of money came out, a little fluff came out of the large cap tech stocks, the giants, and it went into the other sectors of the market. Is it a long-term trend? Is it something that can be persistent, or is it something that's just a flash in the pan? What started it really was a few weeks ago, when expectations of stimulus were going to come out. There are still expectations of stimulus, regardless of who wins the White House, and we're getting through that. Okay, Biden looks like he won, and you could argue with me about that, but that's okay. It is what it is, right? I don't want to get political here. I'm just telling you what I'm looking at. All right. But we'll see how the certifications come through. Boy, I hate getting political on the show, but unless it has something to do with money. So it does, because a lot of political uncertainty can weigh on the stock market. And then you had this past Monday, only 2 days ago, news that Pfizer has a vaccine for COVID that's 90% effective. I think Pfizer is very highly confident, because it's unusual for a company of Pfizer stature to be, very uppity, very confident, and talking so positively about a drug or anything that they create, if they didn't really think it was about to be approved. So it's really a game changer. Yes, there's always a risk that it doesn't get approved by the FDA or it doesn't quite work as well as we thought. But I don't think Pfizer would report these results and talk so glowingly about it if they didn't have something there. So we're believers. I'm a believer. Um, so you have just this massive move of sector rotation or accelerated move from out of the big tech stocks into the industrials, the energies, the financials, the materials, the energy, the consumer discretionary. And we'll just from now on just economically sensitive stocks for the rest of the day. And that's what happened. Today wasn't quite like that. It reversed a little bit, but we don't expect this to go in a straight line. There have been a lot of head fakes every time we hear positive news about vaccines. Techs go down, the rest of the market goes up, and then our hopes are dashed, and then we're back to the drawing board. But this time it looks like it's going to stick. There's no guarantees. How do you play this? The real deal, what I said to my friend over at CNBC today, what I said to him, though, is you have to have both. You don't have to do anything, but my recommendation is, my advice, my opinion is you have both. I don't think you want to have a portfolio where it's so lopsided that you just decide to sell all of your work from home winners, just get rid of everything and put it all into economically sensitive stocks. We don't know how this is going to go. We can't read the future. We think it's going to go well with the vaccine. It's still going to be it's still expected to be a brutal winter for COVID cases. I'm reading some really horrible articles, about hospitals in Austin, Texas, having to call up portable refrigerated morgues. It's really sick stuff. I mean, this is really morbid. So we have a tough winter to get through. And even when the vaccine does come out, it's a very complicated, difficult vaccine to make. It's got to be stored in extremely cold temperatures. You have to get 2 doses. It could take a long, long time for everybody to get this. So, but that's the sector rotation. I think the best part of it, from tech to economically sensitive, is already behind us. And now I think we just kind of seesaw back and forth between the two, but with a somewhat barely discernible trend that continues into the cyclicals and out of the technology stocks. Okay. I've got a comment out here. I always like to look at my comments before I put them on the screen. Jerry is out there. Hey, Jerry. Good to see you, my friend. I'm so glad you have joined us. Thank you very much. If you have any questions, Jerry, hit me up in the comments. Give it my best shot. Give it my old college try. So let's keep going, okay? And I want to show you a couple of other things, but did you know that there are more than 500 companies in the S&P 500? I think there are 505 or 506 companies now. I've looked this up at a couple of places, and I keep getting like 505 or 506 or 504. But the reason is this. For example, Alphabet, which used to be called Google. Okay, Google is now just a division of Alphabet. But let's just go with Google. Okay, you have Class A shares and Class B shares. So that's 2 entries from one company in the S&P 500. Under Armour is in the S&P 500, and they've got 2 classes of shares as well. So you've got 2 extra stocks just from those, and I'll show you which ones. But we're gonna keep going here. All right. What is ineligible from being included in the S&P 500? Well, first of all, ETFs, exchange traded funds, limited partnerships, master limited partnerships, and REITs are not in the S&P 500. Okay. Actually, I have to double check on REITs, but definitely, they're not in the S&P 500. The S&P 500 has something called a beta of 1. 1 means this. However, the S&P 500 moves is given a valuation of 1. So if a individual stock moves 10% more than the S&P 500 up or down, it's got a beta of 1.1. And if a stock moves only half as much volatility on a day-to-day basis as the S&P 500, it's got a beta of 0.5. So when we look at a portfolio that we create for a client, we look at the beta and say, does this have more beta or less beta than the S&P 500? So if you're like a conservative investor and let's say you're kind of, getting closer to retirement, you don't want to take as much risk, you don't have as much time ahead of you to recover from a severe, prolonged bear market, you don't want a portfolio with a beta of 1. You probably want a portfolio of maybe 0.4, 0.5, or 0.6. Okay. So that's how we talk about beta. All right. I see a few people out there, a couple of peeps, a couple of my homies. Steve is out there. Hey, good to see you, Steve. Thank you so much. You've been watching a lot lately, so I really appreciate that. Eric Michaels, what's up, buddy? Good to see you. Guys, if you have any questions, words of wisdom too are always appreciated. But if you have any questions, hit me up in the comments below. Okay. That's what all the YouTubers say, right? All the YouTubers say, ask me in the comments below. I'm a big YouTube watcher, so I know these things. All right, so ineligible REITs, limited partnerships, master limited partnerships, and ETFs. Beta of 1. The very first index fund to track the S&P 500 came out in I think it's 1976. Okay, and it's Vanguard, the very first S&P 500 index fund. The creation of John Bogle, who is no longer with us. And the reason he brought that out is he said that if you have lower expenses and lower trading fees, that alone would, and lower taxes, that alone would be a boon for investors. And I think he's right. Okay. I think we really can't argue against that. So by the way, folks, when I talk about the S&P 500, for or against, actually, this isn't a for or against thing in the S&P 500. I do think the S&P 500 is a markedly different index, though, than, the whole concept of what it was, 50 years ago is very different, 40 some odd years ago, than it is now. So I do have some issues with the S&P 500. I'm not knocking it. I have plenty of assets under management that are in ETFs that track specifically the S&P 500, and just all my benchmarks are also the S&P 500, or at least the stock component of the money I manage. Some clients have bond components and stock components, so we use a blended benchmark. So I'm not knocking the S&P 500, and I think it is a very useful tool. That's what it is. It's a tool. I use it for my clients, and I have no problem if somebody else uses it. It's just one of my tools. I don't look at the S&P 500 as the end all and be all of financial planning and asset management. Oh, just put everything in S&P 500. You don't have to ever think about anything again. Far from it. And I think you'd be making a mistake if you do think that, in my opinion. So I'm going to show you the most important thing here. By the way, the S&P 500 was, in its current form, it was created in 1957. I know a lot of people see charts go back to the 1920s, but in 1926, it had 90 stocks and it was just called the composite index. And then in 1957, it was jacked up to 500 companies in it. And that's when it basically took the form that it's in now. So 60 some odd years ago. All right. So I'm going to show you now the most important thing to me about the S&P 500. And if you are looking to rotate yourself and have less exposure to technology and more exposure into the reopening / economically sensitive stocks, the way to do it is not to put more money into the S&P 500. The way to do it is one way to do it is to take a look at the ETFs that represent the 11 sectors of the economy, like industrial, materials, financials, energy, consumer discretionary, and pick among those to get extra added exposure to the economically sensitive sectors, as opposed to just picking up the S&P 500. I'm going to show you why now, and you should definitely know. So this is really interesting. By the way, this what you're looking at, this chart here, okay? This by the way, this chart that you're looking at, this is up to the minute. So these are the closing prices today of the S&P 500 and how much each company represents of this benchmark. So I'm going to tell you this. Apple is a little over 3% of the benchmark. Now, I know what you're thinking. Oh, Apple, 3%. of, if you've got a big portfolio, 3% in one stock, it's not the end of the world. It's not that big of a deal. It's a great company. But then you have almost 3% in Microsoft. And then so you have Alphabet, two classes of shares, Berkshire Hathaway, that's the B share. What you're looking at, though, is if you take a look at the top couple of stocks, they're like 25%, the top stocks. Look at Alphabet, 10%. Alphabet is not 22% of the S&P 500. There's a little bit of something funny going on over there. But the point of the matter is, if you look at the biggest companies, Johnson & Johnson, Visa, you're getting the same stocks in a lot of large cap index funds, mutual funds, and ETFs. So this is why I say it's at this time of life, in this time of the evolution of the stock market, the S&P 500, these mega cap stocks have aged in reverse. Usually when a company gets bigger, they slow down. These companies get bigger and they accelerate. It's just a completely different paradigm. And then you take a look at what I really want to show you is the percentages of each one. I think this is the weighting up. Okay. I feel so silly right now. The weighting. Forgive me. I'm going to start this again. We're going to start the whole show again. Apple, great company, 6.3%. I made the screen bigger so everybody could see it, and I missed that. Apple is 6.3%, as you can see, of the S&P 500. Microsoft, 5%. Amazon, 4, almost 4.4%. Facebook, over 2. Alphabet, 3.4%, 3.5% of the index. Berkshire Hathaway. But if you look at these stocks, you have such a concentration in these large cap stocks. And if you look at the 1%ers, by the time you get to the 16th largest holding in the S&P 500 index, Disney, it's less than 1%. It's 0.87% of the benchmark. And that's what I want to show you, that, yes, it's a very diversified index. Maybe it's too diversified, but there are so many companies in here, and I want to scroll to the bottom, and they're so small that when you get to the bottom of them, okay, you wonder, like Under Armour Class C is 0.0087%. Apache is 0.012%. It's almost like, what's the point? You could literally knock out the bottom. American Airlines is 0.02% of the benchmark. And this is the thing that I think people are missing about the S&P 500 is you hear 500 stocks, but the bottom 100, 150 stocks are such a small part of the index. There's such a small representation that if you took I would say if you just took out the bottom 50 companies and just they went to zero, I don't think you would even notice it. I don't think the benchmark would change much at all. You'd hear about the companies going under, the stocks going to zero, and all the layoffs. But as far as the benchmark goes, I don't even know why you bother with these. So one of the benchmarks that I use for clients is the S&P 100, because I at least feel like I'm putting some money to work in 100 companies, as opposed to the S&P 500, where I'm putting money to work in really just what I feel like is just a handful of stocks. All right, so that's where I draw the difference. So I wonder how many of you actually knew that the bottom companies were such a small representation of the S&P 500. So that's my story. I'm sticking to it. These are some fun facts that you should know about the S&P 500. We're all exposed to it one way or another. Sorry about that snafu with the percentages. I was looking at the wrong thing there, but you get my drift. It's basically a large cap tech and communications fund with a smattering of a lot of tiny little positions, as opposed to a more concentrated fund with, let's say, 50 or 100 stocks. And if you took out one more thing I want to show you. So what if you did it in reverse? Oh, this is really good. Just stick with me for one more second. What if you took a look at an ETF? It's called the reverse cap weighted fund. Let me just make this a little smaller, okay? The reverse cap weighted fund, what it does is it takes the S&P 500 and it reverses the weighting. So it overweights the smaller little tiny companies that I showed you at the bottom, and it underweights the really big companies that I showed you at the top, like the Apples and the Facebooks, et cetera, the Microsofts. And if you do that, the S&P 500, I'm going by the S&P, the Spider SPY that tracks. It's the biggest ETF that tracks the S&P 500. That's up 10% on the year, and the reverse is down 1% in the year. That just gives you a good idea of the performance of where the performance is coming from in the stock market this year. It's nothing new. I think, we all know this, but when you see it graphically like this, I think it just hits you with another way to look at it. So that's about it. All right. I appreciate you taking a look, and I will speak with you soon. Thank you very much.